This episode of Fintech Insider is brought to you by Fireblocks, the stablecoin infrastructure platform trusted by top global businesses such as Visa, BNP Paribas, Revolut, and more. Fireblocks powers over $100 billion in monthly stablecoin volume, helping PSPs, fintechs, remitters, and banks issue, move, and manage stablecoins, all securely and with built-in compliance. Get complete control to build your stablecoin strategy, manage liquidity, and on-off ramp in over 60 currencies, all at scale. Learn more at fireblocks.com.
New Vitamin Water Zero Sugar Pineapple Passion Fruit is packed with vitamins. Just like the amount of peas we packed in that sentence. It's packed like your tote bag. The one you stole from your ex. Or your overpriced half a studio apartment. Or extra rushed rush hour traffic. Packed like your calendar. Triple booked at 5, of course. Grab a vitamin water. Did we mention it's packed with vitamins?
Hello and welcome to Fintech Insider Insights in partnership with AdalFi, live from the very first Money20 Saudi. I'd love to get a show of hands from people outside. Can you show of hands? Who's listening in? Yeah, you're listening in. 1, 2, 3. Oh, I got loads of. So for those of our listeners who are not here, we are sat very close to an extremely large duck, which is kind of interesting. And we all have ducks on our table as well, so there's very much a duck theme. We'll try and weave that into our discussion somehow. We're gonna do some lending to ducks somehow. But nonetheless, I'm David Barton-Grimley, Fintech Strategy Director here at 11FS, and we've got a very special live episode coming up for you today. We are diving into a critical and fast-evolving frontier of financial services, and that is the future of underwriting. So where consumers, SME, and data collide. And I think it's a particularly exciting being in Saudi and being in the region. It's a huge theme for everyone here. I've certainly been picking up on that in the Money20 conference. But here's the twist. In today's digital economy, SMEs don't exist in a vacuum, right? They sit between consumers and banks, often serving one and being served by the other. As such, banks and BNPLs increasingly find themselves holding different parts of exactly the same puzzle. So today we're going to explore the potential of transactional data, so particularly things like real-time cash flow, to offer a more dynamic and accurate view of a business's financial health. And we'll look at how leaders, fintechs, BNPL providers, and banks can share intelligence to serve SMEs better without compromising on risk or compliance. So we'll be looking at the shift from static risk models to dynamic flow-based underwriting, how banks and fintechs are partnering to build infrastructure that scales trust. But before we get to that, let me introduce you to today's wonderful guests. And first off, we have a Fintech Insider debut for Salman Akhtar, CEO and co-founder of AdalFi. It's great to have you on the podcast here in Saudi, Salman. Tell me a little bit about AdalFi and your time. How's the conference been going?
Sure, thank you. And great to be on the podcast. So AdalFi is a lending infrastructure company. And what we've done for the last 4 years is, first of all, building credit models that work on bank transactional data, because we took a view that for alternate data scoring, this was the sort of gold dust that you could rely on to score those hard-to-score segments, people like SMEs, people like non-salaried customers, people like thin-to-file. So those are the segments that we score and work with our lending partners to enable lending. And one last piece of AdalFi is that we have this shared revenue, shared risk model. So we literally stand behind our models and we will share in the risk along with the revenue that is earned from the loan that goes out. So far, Money20 actually totally beyond my expectations. So this has been great. We've had a lot of very interesting conversations. The stall is, a lot of people come by our booth. And it's really been actually way beyond my expectations.
Yeah, that's awesome. I echo that as well. Thanks. Super interesting. And we have another Fintech Insider debut for Walid Hassouna, CEO at Value. Welcome to the podcast, Walid. Tell us a little bit about yourself and Value.
Okay, thank you very much. I'm so glad to be here with you in the podcast, and also so glad to be in Saudi with the first Money20 conference. I'm a banker. So I started my life as a banker. Most of the fintech players, they started in tech. So I started in banking, and I was doing a very different thing than what I'm doing right now. I used to be the head of that capital market for multiple investment banks. So I was actually raising a lot of money for very big corporates, whether this is direct facilities, sukuk, or bonds and other things like that. And finally, in 2016, I was part of the EFG group. I was heading DCM. I was heading NBFI, and we wanted to start a consumer finance business. This is how Value started. So we were not a real startup, but actually it was as a corporate innovation within the EFG wall. What we do is that we underwrite customers for credit, and we have the best of the two worlds. We are very fast as the buy now, pay later, but we can offer you solutions from $1 to $1 million. So basically, we're not focused on a certain segment nor sector. So we can do grocery, and we can do boats and yachts. We started in 2017. We were the first player in the Middle East to be called as buy now, pay later. Although we weren't, but we were the first one to have this term in Egypt at that time and in the Middle East, and we haven't raised any money except $10 million from EFG, and another $10 million came from Amazon. They invested in the company in a convertible in 2022, and they converted this year before we go public. Now we're a public company. Market cap is around $360 million. We have 1 million plus customers, which is very big in Egypt compared even to the banks. We are the third or fourth biggest bank for number of customers. And we have more than 12 products. One of them, of course, is funding our merchants. So we've been into SME, we've been funding our merchants for a long period of time. And now we're getting licensed to provide SME financing across Egypt. And our next market is going to be Jordan.
Amazing. What an incredible story, and such a huge company. That's so cool. Welcome on the pod. And finally, we have another debut on the podcast for Abdallah Al-Moyed, founder and CEO of Tarabut. Great to have you with us, Abdallah. Please introduce yourself and Tarabut for our listeners.
Pleasure. It's great to be here. This is home turf for us, so it's great to see everybody that we know and have been in contact with for a while visit us here and see what's actually happening on the ground. Just a brief on Tarabut. We're an embedded finance and open banking platform. We leverage open banking and open finance to help lenders unlock new opportunities. What we say internally is we help lenders unlock, understand, and serve new segments that they don't currently do. This is typically leveraging open banking and other data sources that are available. I think, to me, having been in London for a long time, we also acquired a company based out of the UK. We know the markets globally pretty well. We're operational across Bahrain, the UAE, Saudi Arabia, and London. But it's great to see people's reactions when they see what the infrastructure is like out here when it comes to alternative data. So something we're very closely monitoring and we're working alongside. We typically serve banks and lenders. That is what we do. Again, as I said, helping them unlock, understand, and serve their customers or new segments of customers better.
It's amazing. All right, let's get into it. I mean, I think what's very cool about the three of you is you each represent a different part almost of the value chain, and also different geographies. So we've got a really good spread of opinions and everything like that. So Salman, I'm going to come to you first, and I suppose the thing to set the scene for our listeners, a very international audience we have, is like what's the tension? What's the problem? Why can't SMEs get the lending? Why are we still in? It's 2025, right? Fintech's been going on for a long time. What's the tension? What's the issue? Where's the opportunity?
So SMEs are just notoriously difficult to score for many, many reasons. Obviously, the fundamentals of credit scoring as they apply to consumer lending, and the S part of SME kind of bleeds over into consumer lending. The numbers are of the same order of magnitude. So the fundamental premise of lending to and scoring on the consumer side is stability, income stability, spend stability, repayment stability, etc. Okay. SMEs, and especially the S part, are really characterized by instability. It's a lot of variations, seasonal variations, sales variations up and down. So they've always been extremely difficult to score. And one example of that is that the US, which is the most sophisticated credit market in the world, even over there, the S part of the SME, the statistics from the Fed is that about 30 to 35% of all small borrowers in the US have to rely on personal credit cards.
Wow.
They do not get access to credit. So that just tells you a measure of the problem. Now, of course, as we all know, every country in this region is really trying to push the SME agenda, across the whole region. And the problem is that the scoring or the risk analytics part really is historically not been fit for purpose. So that's been one large part of the gap. The capital is there to be lent. It's just that it doesn't know whom to lend to. And that's, to my mind, been a big part of the problem.
And that's the big opportunity.
Yeah.
I mean, Walid, how are you seeing this in Egypt from a BNPL perspective?
So Egypt actually has a lot of unbanked customers.
Yeah.
And even if you look at banked customers, you will find most of them with no credit history. When we started, we wanted to disrupt a very simple thing. We wanted people to get credit and get it right now. And we were only competing with banks or brick and mortar financing houses. Banks, until now, they think that the most important product that they have on lending would be credit cards, because this is where you can split payments on 3, 6, 9, 12 months, what we call an EPP. And the problem is, if I'm in 2017, before value has come to the market, if I want to buy an iPhone, if I want to do a surgery, if I want to pay for education, I need to issue a card. And issuing a card will take, until now, around 20 days between underwriting, documentation submission, review, issuing a card, activating the card. And of course, it's plastic, so you have to issue the card. When we came in, we were just thinking about, if this is going to be the case, then the customer would never make an impulse decision of buying, or will never be ready when emergency is needed. So we wanted to make this happen when we started, it was like 45 minutes. Now it's like 3 minutes, but
Wow.
but now it's 100% digital. When we started, we couldn't do 100% digital because the e-signature and EQIC was not working in Egypt. And now we have an option of 100% digital that we are just launched today with Noon in Egypt. But still, customers, they want to physically come to us. So we're still going to have this physical locations, but now it takes around 3 minutes to get onboarded. And the question was how we're going to build a credit scoring system on customers that might be unbanked. And we were very realistic on that. So we decided what we're going to do. Okay, let's build the credit scoring, the instant credit decision, only for customers with credit history. And this might look like a stupid decision because we don't have open banking tools. We don't see transactional data. But we said, this is the best way to get our model to learn. So let's do it. And we established a rule engine that worked on whatever available in the credit bureau and make a decision in seconds. When this worked for us, now we want to get to the unbanked, because if we keep competing with the bank customers, this is a very limited pie to work on. And the problem is, if we continue doing this, then our cost of fund is always going to be higher than the banks. And if the banks improve their underwriting, then there is nothing to offer to the market. So we decided we want to do the unbanked, and we started like every other player who wanted to do unbanked at this time. We got into surrogate programs. So what card do you have, where do you live, demographics, things like that. And this, of course, was not efficient enough. So we decided, okay, why don't we underwrite 50,000 customers for very small limits, people that we usually reject, that don't have credit history, and we don't know why we reject them, but reject them. And then we collected all the data and started to use AI and underwriting methodologies through machine learning and other things to decide on customers. And we were doing this with a lookalike. So if we have a banked customer that we have underwritten 2 years ago with certain features, we compare this to our new customer who's just knocking our door and see the feature importance and decide on those customers. Now we're able, not now, actually 2 years ago, we were able to launch what we called our Rule Engine 2.0. And our Rule Engine 2.0 was able to underwrite customers seamlessly for banked and unbanked customer. Our current acquisition is 60% unbanked customers, 40% banked customers. This is our current acquisition. Our portfolio composition now is around 50-50, and we are moving more into the unbanked because we're able to underwrite customers without the need of having all the data that we used to have before. Also, the infrastructure in Egypt is not helpful enough. So we cannot get data on, we don't have GoSee, for example, like in Saudi. We don't have any data on customers, how much money they make and how it works. So what we do is that we underwrite the customers, and then we use our spending data habits of those customers on our platform,
Right.
and feed this back to our system and try to understand if we underwritten the customers right or wrong, because basically we don't have enough data. So we're trying to use our own data as a way to underwrite customers again and again and again. And this continues to happen every day.
You have to take a little bit of risk. You're giving a little bit of risk and saying, hey, we're going to give you a little
Not a little bit of risk. We took high risk, but now our performance is very good. Our default rates are below 1%, which is, compared to the national average in Egypt, which is 6%, is really amazing. And we're now giving some banks that we work with underwriting as a service for their credit card issues.
Got it. Abdullah, I want to bring you in on the open banking perspective, because so much about what both of the other guests have been talking about is about data sharing, and how what is the role of the infrastructure in all of this?
So a few things, and I just want to go back to one of the points that the colleagues did or made. This market is very, very, very different than what was just mentioned, and I would argue that the US is not the most sophisticated market out there. And there's a few points to back that up. Let me just draw out a picture for a second for everybody here. Imagine everybody in a country having a digital identity. Imagine electronic signature laws being enforceable by law. Imagine having the cloud mandatory to every operational bank or fintech or data holder. Imagine APIs being standardized across an entire ecosystem. And then imagine a judicial system that is digitally enforcing through APIs alongside promissory notes at the point of lending.
Wow.
That is what Saudi Arabia is today. We talk about unbanked or underbanked. Well, Saudi is not unbanked. Saudi is multi-banked. Everybody in Saudi Arabia has more than one bank account, which means that when you lend, be it an SME or a person, the question is, where do you get that source of data from? It could be from the GOSI, the General Organization for Social Income. It could be from the bank transactions, it could be revenue-based financing, but the identity and the KYC and the KYB and the onboarding is all completely digitized.
Right, that's taken care of.
That's all taken care of. So what that means is, from a lender's perspective, and I agree to what you were saying earlier, is our role is to start advancing these risk-adjusted models that allow us to serve these customers better. So what we strive to do at Tarabat is not really serve the underserved, but we're one chapter ahead. What we want to achieve is intuitive financial services, is where the user's requirements are predicted before he actually needs them, or when lending is actually pushed towards them to say, hey, you're already approved for 300,000 riyals, would you like to go ahead? Straight through processing is table stakes here. Right? Straight through processing is completely table stakes, because what has happened is the government is ahead of the financial services sector.
Yeah.
So let me give you an example. A few days ago, Tamara just announced $1.4 billion. $2.4 billion backed by JPM, Apollo, and Citigroup, I think, or something like that. Well, there is a reason they're putting their money here. The reason is because this debt portfolio has so many parameters available to them that are not available in other jurisdictions, which means when you price it, this is a very, very attractive market where enforcement gets digitized. If you default on a payment, there's a lot of prerequisite work that has been done, which makes our job as technology players a lot easier. So the parameters or the data fields that we have. So we always say, yes, we're an embedded finance player. Yeah. Open banking is just one of the attributes that we use to be able to leverage transactional data and do that. But the reality is, I'll give you another example. And people tend to think, by the way, open finance, financial inclusion is for the bottom part of the market, microfinance, BNPL. I'll give you a very simple example. we built a product with American Express. American Express Centurion cards. Guy's in New York, going out shopping, calls up Amex. He's like, hey, by the way, I need $250,000. I'm about to go shopping. They pull up his credit score. They have nothing. The guy is self-employed, owns his own company. The money's in his account, but he doesn't have a credit bureau score. He doesn't give himself an income. He doesn't give himself a salary, and he doesn't have a GOSI score. So how do you serve that part of the market? He calls up, and American Express historically has been credit scoring people on the basis of their habits within their closed loop ecosystem, which is very similar to what you guys do. And here, the guy is new, he's a billionaire, and he wants a quick credit card. If they reject him, he's not going to bank with them anymore. So what do? And this is where open banking comes in. The guy calls up the call center, goes on the app, requests a limit. They ask him to do one thing. They pull the API from the credit bureau, comes out negative. The guy doesn't even have a credit bureau score, but they know he's good for it. Link your bank account. They see he has a deposit, he has a fixed deposit, boom, you get the credit limit.
Yeah.
So it's also for the upper end of the market. And people tend to misconceive or misunderstand exactly where financial inclusion is. What we're trying to do is bring everybody in. Not necessarily just the blue collar or the gig economy and things like that, but it's also being able to better serve the other segment of the market.
Yeah, and that resonates a lot with what we see at 11FS, which is that the types of jobs, and this goes back to what you were saying initially, Salman, the types of jobs and employment globally are changing. You know, people are becoming a little bit more freelance, a little bit more transient, a little bit more international. They're moving across country. I mean, we see this so much in Europe and whatnot. And a lot of what you were saying, by the way, it resonates to me in the UK. It comes down to UX, right?
Yeah.
It comes down to that UX. It's all very well that you have the infrastructure, you have everything like that, but what is that sort of final UX? And if it's not there, then sometimes the customers do get underserved, and there is propensity to loan.
Yeah. And, just to follow up on the comment that was just made, I think it's because we're talking about lending, the issue is not financial inclusion, it's really credit inclusion. And you could be credit excluded at any point in that entire kind of range of the population. You could be at the very top, you could be squarely in the middle and still be credit excluded, and you could be at the bottom. Of course, the money is middle up, because definitionally, the unbanked, the very poor people, you can only lend small amounts of money. So you can't make a lot of money of lending to those people. Nano credit being one great example of that. Really not a lot of money to be made over there. So the money can only be made if you can essentially lend long and lend large. Right? That's where the money is. And coming back to the point that you were just making on the UX, so 100%, to my mind, the idea is really how quickly can you make that accurate credit decision? Is it 1 minute? Is it 1 day? Is it 1 week?
Yeah.
And if you're at the 1 week level, the game is over. You really need to be at the 1 minute level. And I totally agree. That should be table stakes across the board for everybody. And there are ways of doing it even in less advanced economies. As was just mentioned, Saudi being a great example of a lot of the infrastructure being in place. So, for example, some of the work that we've done in Pakistan, where a lot of this infrastructure is not in place, but we could see that we could do this within banks to their existing population. So we could do STP within a bank, 1 minute, disperse the loan, credit decide, disperse the loan, STP, boom. And that experience, by the way, completely changes your drop-off rates also. Because, you come in, you apply for a loan and says, oh yeah, see you later. After 2 days, I'll give you a credit decision. That whole thing that you just talked about the medical emergency or the impulse buy. If you're going to take even 1 day, the game is over.
Does that make sense?
Yeah, absolutely. By the way, just on that note, we're going to take a quick pause here for a quick break. Be back very shortly.
This episode is brought to you by LinkedIn. Psst, healthcare pros, word's out, and it's too good to keep quiet. Look, LinkedIn is revolutionizing job hunting, making it possible to search by specialty, shift preference, and salary. Endless scrolling is out. Whether it's a mental health therapist or dental hygienist, finding the perfect role is faster and easier than ever. Head to linkedin.com/healthcare and start your search today.
In today's fast-changing digital world, proving your company is trustworthy isn't just important for growth, it's essential. And that's why Vanta is here. Vanta helps companies of all sizes get compliant fast and stay that way with industry-leading AI, automation, and continuous monitoring. So whether you're a startup tackling your first SOC 2 or ISO 27001 or an enterprise manager vendor risk, Vanta's trust management platform makes it quicker, easier, and more scalable. Vanta also helps you complete security questionnaires up to 5 times faster so you can win bigger deals sooner. The results? According to a recent IDC study, Vanta customers slash over $500,000 a year in costs and are 3 times more productive. Establishing trust isn't optional. Vanta makes it automatic. Visit vanta.com/insider to sign up for a free demo today. That's vanta.com/insider. Welcome back, everybody. So in the second half of today's show, we're looking ahead at what happens when underwriting becomes continuous, not static. We'll unpack what this shift means for lenders, SMEs, regulators, and consumers alike, and explore how smarter infrastructure, AI, and federated learning could reshape credit access across the ecosystem without compromising trust, compliance, or control. So I want to actually start off by picking up the point I think that you made, Salman, about about banks, right? In that, like, a lot of what you do is working with banks. So I would kind of want to open that up to a conversation about the role of banks in this, because so far a lot of what we're talking about is alternative lending. It's non-bank lending. It's outside. And well, in Egypt, you know, where do you see banks participating in this? Because you're talking about filling a gap that they're not filling. Are they going to fill that gap in the future?
I think in Egypt it's very different. So we don't have the infrastructure of Saudi. We don't have the interest of the investors as much as Saudi, because Saudi has the infrastructure, the legal structure, and everything. So we need to work with banks. So we're fortunate enough. I don't know if this is something good or something bad, but when you look at it, in Egypt, we had access to bank debt when we started. Normally, buy now, pay later consumer finance are not getting access to bank debt on the spot here. And in UAE, for example, they need to prove themselves first. But in Egypt, there's access to that because banks has very limited options to deploy their money. And that's why we were able to convince banks that we can play as partners early on in the process. Very early in the process, we were able to convince them that we are going to be your wholesaler. We're going to be your retailer. We are going to bridge the gap between you and the end user. So it started with getting funding from the banks and on lending this to our customers. Mm-hmm. A couple of steps later, I don't want to say years, month or what, but a couple of steps later, they came to us and said, okay, why don't you issue securitized bonds? And it's really a very good idea because securitized bonds is the main fuel for this business. And in Egypt, we have a very deep securitization market. Very deep, very good, has been there for 25, 26 years. People understand it. So they started actually issuing us securitized bonds. So we were able to access funding at a very cheap cost, which enabled us to take a lot of risks because we can understand now, we can try those set of customers, and if they're not good, we try another set of customers. And finally, last year, we started looking at banks and telling them, why don't we help you bring the customer and underwrite the customer, and we can buy this asset without the need of having a securitized bond? Why don't you take it like directly? Yeah. So what we do, that we went to some of the banks, and of course only banks adoption is very difficult. So we went to 3-4 banks, I remember. We were pitching a very simple thing, very, very simple thing. Guys, we know how to underwrite people for credit cards because what we have is very similar to a credit card. So we know how to underwrite people for credit card. You're actually issuing cards for people because they have value, and you're asking them to shut down their value account to the DBR becomes bigger, and you give them a credit card. Why this hassle? Why don't we give you the customers ready? Why don't you give us your rules? We put this in our rule engine. Whenever we underwrite the customer, if he is good for a credit card, we send it to you. And we have issued this with one bank. Yeah. Now it's the fastest growing credit card in the market. We have more than 50,000 customers in less than 9 months. And 50,000 credit cards in Egypt for a bank in 9 months' time is something that is phenomenal. Not here, not in the UAE, not in the US, but in Egypt, it's phenomenal because the bank that does 3,000 credit cards a month is a big bank in Egypt. So we've been doing this. So
It hits the scale much faster than...
yes. So actually now we are able to work with the banks. We're able to provide solutions for them. They see us as a wholesaler or retailer, whatever it is. We bridge the gap with the merchant. And now they want to work on our POSs because they want to avoid payment for the scheme, because those are closed loop things.
Yeah.
So they're using, this is the next thing happening in Egypt. And in Egypt, you have to be very efficient because the competition on talent is very strong. So we lose people every day for Tamara, for Tabi, for Tarabut, for other players as Egypt. And we can't afford, because of our current situation and the currency situation, we can't afford to compete with that.
Yeah.
So we're becoming more skinny and more efficient. So we still need all to work together because the government is not helping. So we need to work together.
Yeah, we're going to get there in a minute. I mean, Salman, I imagine a lot of what he was saying resonates with you because you a lot of what you're talking about is partnering with banks and making their risk models better.
Sure. So we took from day one, we took a different approach where we said, look, we don't want to have a balance sheet at all.
Mm-hmm.
We actually want to be in the business of being a pure tech company, which builds these better scoring models and these digital journeys so that we can first enable banks to just take their existing customers and lend to them much more efficiently, STP, 1 minute decision, 1 minute disbursement. So for example, in the SME space, where literally it would take people weeks to get any kind of credit done. And it is kind of a weird situation where banks did want to lend to SMEs because there was like a central bank kind of mandate, but they had a real hard time finding viable customers and viable prospects. And we went back and said, look, why don't you let us mine your existing deposit base, your existing account base? And there's a bunch of really good prospects in there. And the first thing is just surface those prospects. Why do you even want to go outside? Why even bother with anybody outside when you've got them sitting on your liability side of the house? They're existing customers. Just lend to them. Okay. So that was kind of the first stage of this, which is really understand and prove out the model with your own existing customers. Get vintage of loss rates on 3-year, 4-year kind of long portfolios, build that confidence. This scoring method really works. You could take bank transactional data, just completely score it on that. And then now we're at a point where banks are saying, wow, this is great. By the way, our cost of customer acquisition was zero because these were existing customers. It didn't cost us a penny. So, and the other thing is, you see, at the end of the day, to make money in the lending process, you've also got to eventually make sure they pay. And as it turns out that if they are your own customers from a bank's perspective, you can do things that are harder to do if they're not your customers. For example, you can do auto liquidation, etc. So you can make sure that they're you get the money before they can actually use the money for any other purposes, etc. Because it's literally your bank account. So it's really this whole ecosystem that we built together. And now that that's done, banks are saying, great, you've proved the model, it scales. We've done like 400,000 loans, etc. So it scales. Now we're in the business of bringing on what they call new to bank, so new customers, etc. And we could, because the models have been proven out. So I think it's, our view was always the deepest balance sheets are always going to be the banks. There's no way any fintech or anybody can really raise anything which is even 10% of the balance sheet of one of the larger banks. So why not fully leverage that and use them and really sort of work with them as partners?
So the future is still bank, right? It's not changing. It's just and we see that generically.
They're going to be for the long time. They're going to be part of the future because they have the huge liability books, which gives them the ability to do low cost lending because the cost of funds is very low on a huge part. It doesn't mean that other people don't have a role, because at the end of the day, banks are always picky and choosy and not going to do that segment, not going to do this, not going to do that, and that creates opportunity for all the great fintechs and all the other kind of non-bank financing companies to find their own kind of space and lend to those. But the big play is still, the big needle is really moved with these guys.
Yeah. Abdullah, I'd like to come to you about open banking and I guess open data more generically, because a lot of what we're talking about is these individual businesses coming up with their own sort of credit models and their own aggregated data. Do you see open banking almost growing to become open finance and open data? Is that kind of on the roadmap?
Yeah, without a doubt. I think I'll tell you what I've learned over the last decade working with banks. And by the way, 85% of what we do is work with banks or lenders. Until about a year and a half ago or 2 years ago, everything was digital led. And when it's digital led, it never works, in my opinion. One thing I do now within our company is if it's led by digital, I'm not interested. If it's led by business, I'll talk to the guy.
Yeah.
I don't care how senior the guy is in the digital team that comes to me and wants to do robotic process automation I'm not interested. I am here to help you unlock your balance sheet. And that is the only conversation I will have. How is a different story. Let the digital guys figure it out. So the working with banks, I think, for as long as there's this battle between digital and business and digital wants to be the innovator, it's nice. It will never see the day of light.
And are you seeing that understanding improve within the banks that, hey, actually, if we use this data properly, we can unlock that balance sheet?
I think it is partners like us
they're doing
that after a decade start realizing that it should be the business guys that we're talking to, because these are the guys that understand numbers. And if you unlock the opportunity, then the digital basically follows.
Sorry, by the way, literally could not agree more.
Yeah.
It's only the business that drives the business. And any bank that's thought, oh, you know what, anything to do with digital, my CDO, I'll give him a little bit of a P&L also. He'll drive some liability account generation, some asset generation.
Never works.
Never works.
Yeah.
Never. Because you know what? They're happy with acquiring 100 lenders.
Exactly.
Oh, we are doing lending. Fantastic. Couldn't be better. And the business is looking at them and laughing. They say, what are you guys talking about? This is a joke.
And just to go back to the earlier point, so business doesn't need to change because all the banks that we're talking about are making a lot of money. Right. And we come in, we're loud, we're complicated, they don't understand us, but we're talking about taking lending from 15 minutes to 1 minute. He's like, I don't care. I have a backlog of 10,000 applications that I can't even process as it is.
Fine, I'm going to hit my targets. No
exactly.
Worries. Yeah.
And if I'm on a commission, if I'm on a bonus, I'm looking at my quarterly numbers, I'm doing okay. Where does it change? Is either bank leadership, shareholders, board, CEO, whoever it is, that looks at the targets and says, yes, we used to be a value stock. I now want to become a growth stock. Let's 3x this. Head of retail, head of wholesale, head of SME, I just 3x'd your targets. Figure it out. Take the digital guys, go offsite, bash your heads against each other, come back to me with a plan. That is what banks are not doing.
Mm-hmm.
Now, in my opinion, just to go back to who I think is going to, it's the banks that actually take this approach and come back and say, hey, by the way, we just found this amazing opportunity. I will either securitize or I'll issue a bond or I won't play in the tech game, but I'll play the balance sheet game. You don't need to play both. Some guys are going to play the tech game and say, look, I'm going to prepare my APIs. I'm going to do straight through processing. I want everybody to orchestrate on top of me. Great. But today it's become so consultancy driven, so generic that every bank you talk to has hey, I'm doing embedded finance and I'm doing banking as a service. And well, have you externalized any services? What do your APIs look like? No, but I have a $100 million budget that I've just given to digital team and they're doing it through X, Y, and Z consultants. And it's going to take 3 years. I mean,
it's frustrating that it's 2025 and this is still, particularly with the maturity of these business models and some of these.
By the time the 3 years end, actually the CEO is going to be changed and he's good with that. So he has a very good project. He has a very exciting story. He's going to tell the board every time for the next 3 years. And by the time his term ends, someone's going to come and find out that there was nothing happened.
Yeah.
Very few examples I've seen of banking as a service that are successful. And
I love the fact, by the way, that everybody agrees, which means we're all seeing the same thing. I thought it was just kind of
Let me tell you, we have, over the last 4 years, signed up 17 banks in Pakistan. 17, yeah? Out of those, 10 are live and 7 are still making up their minds, okay? And out of the 10 that are live, 3 have scaled. They give us 90% of our revenue and 90%. And the other 7 like, yeah, we do digital lending, you know? But it's like, okay, guys, seriously. You know, seriously.
I love this.
So the point is, but the good thing is, you know, the balance sheets on the banks are so large. Actually, in every country, you really need only 2 or 3 or 4 banks to try and scale it out. Boom. We're actually all home, you know, with that. The banks are home, we're home, everybody's home. Just 3 or 4 of them have to scale this
That's
up.
all you need.
That's all we need.
That's all you need. Yeah. So this discussion has been very cathartic for me because this is reflective of my career as well and some of the frustrations that I've had. In the closing bit, I'd love to just close the conversation on the future of data sharing, right? And so a lot of what we're talking about here is the credit bureaus are just not seeing, right? They're not seeing where this data is. Some of the banks are not incentivized to see and therefore do something about it. So then what happens in the future? Do the credit bureaus come in? Do they, what?
I want to step in just on one thing here.
Yeah.
It's not that the credit bureaus don't see this. It's really that they choose not to see it.
They don't want to, yeah.
Yeah, because, you know, if you actually go back in the day when FICO first created the score, like 50 years ago, yeah? It was well known at that time that there were 2 primary ways in which you could score somebody's creditworthiness. One was through loan repayment data, which had the great advantage that it wasn't very high volume. It happened once a month, and it was labeled. You know, you either paid or you didn't pay. So it was very easy to model. And the second thing, it was very well known at that point, was bank transactional data. It was just that A, back 50 years ago, it wasn't easy to access. And B, there's a lot of it, a lot more of it. And C, it's not labeled. There's no direct translation from bank transactional data to, you know, kind of, are you a good credit prospect or not? So I think credit scoring and the bureaus got stuck in this groove of doing loan repayment data.
Right.
And now they built these deep models that are really kind of just, you know, take out that last little bit of juice out of that model, and they've invested in it and incentivized to do this. So really, I think that they've kind of just shut their eyes to it because they're a model that works, and hey, what's wrong with this picture?
Don't change it.
Yeah, it's similar but slightly different. I think as far as future is concerned, I think financing is going to become instant. I think data is going to become commoditized, irrespective of where it comes from. I also think it's unfair to have all credit bureaus in the same bucket because some will innovate, some are private, some are government, some are, and the more innovative. But I do think that the reliance on credit bureaus across the board, if it's not mandated by the regulator, would potentially reduce. Because, an example, telcos in a lot of the jurisdictions that we're talking about have better data and more accurate data than credit bureaus do. I'll give you an example. They even track your battery in some telcos as far as charging and things like that. And they can classify you based on charging habits. So there's a lot of data sources that will become available, but it will depend on the lender's ability. Again, business-led, right? Business-led, risk-adjusted, price it accordingly, potentially securitize it. And I think the role in the future is going to be definitely across, in all our lifetimes, I think lending or financing is going to become instant, no matter what the product is. Whether you're buying a car, a home, credit card, it should all be instant. I think APIs will be available across the board. And I think the lenders that will win are the ones that take it one step further, because instant is not going to be good enough anymore. It needs to be predictable. Today, you log into your Amazon account and the first thing that pops up is the kind of books you like to read. It doesn't wait for you to type it in. And financial services really should be like that. We've reached a point where there has been captive data that has been sitting in these banks for the last decades that hasn't been utilized. And in a lot of cases, you go to these lenders and what they'll say to you is, I would rather build a product that is non-reliant on my existing data that capitalizes third-party data because I don't know what's inside here.
It's often easier to do that, right?
Exactly.
Yeah.
So that's where the open banking element comes in, or open finance is I would rather use third-party data because at least I can trust it a little bit. Whereas here, for example, the attribute of the account opening field is non-existent. right? So yes, I have it. So there's a lot of attributes that I think will define the future, but I do think,
Amazing. And Walid, what's your view for the final word?
I think, and I prefer, and I would love to support any idea where credit bureaus are not part of my life. The reason is very simple.
Is it mandatory?
Mandatory.
Every loan has to pull an API?
Yes. Actually, unfortunately, it's not only about mandatory or not. The other thing is there is a cutoff for the score. After that, you're not able to securitize this bond.
Oh, wow.
So this is what I really see Egypt doing wrong right now. They are over-regulating consumer finance, SMEs and everything because they think there might be a credit bubble, for example. And the problem is the way they are doing it is not serving those companies. It's actually putting a lot of cost on us. And what's happening right now is I have to pull an API for every transaction, which I don't mind, but I have an availability of around 80%. There is 20% when I pull an API, actually there is no response, whether there is an API, whether there is a score or not, because basically they are offline. They're not working on weekends.
Oh my God.
There's just to add on Walid, and I completely agree with what he's saying. What's really interesting, and what I've seen in some jurisdictions is that regulators are over-regulating in certain cases when it comes to, for example, especially on the retail front.
Mm-hmm.
Yes.
We've got certain calculations here in the region which are known as the debt burden ratio, right? Above a certain debt burden ratio, don't finance them. Which is pretty limiting because the way the regulator or credit bureau calculates a debt burden ratio is based on expense and income. What classifies income is salary. But what if somebody has another job or is doing something on the side?
Or a passive investor.
Or a passive investor or something like that. Right?
Or a gig worker.
Or a gig worker.
In fact, the whole region has been locked into the salary-based lending model.
Agreed.
And that's what that's the
big target, right?
Absolutely. And that's the lack of credit exclusion.
Yes, because banks started the lending.
No, but
now
you
you understand there is someone new on the ground. We're not banks. We are not going to lend based on salary, because if we lend based on salary, it would be more expensive than what you're doing.
You have to find something.
We have to find someone else.
Yeah.
So if they apply the same rules, how are we going to apply? How are we going to?
I think it really comes back to whoever the lender is, whether it is a bank or somebody like you that wants to lend directly, do you really at the end of the day have the intelligence to make sense of all the data that you have to take a risk-adjusted credit decision? And that's really what it boils down to.
You can build this.
Yeah.
You can build this. You can start any point and then start building this.
Right.
Again, coming back to the credit bureau. So I think everyone is going to connect to his competition and other players to secure data to make a decision whether they need to do it on the credit
assemble themselves.
Yes,
yes,
this is going to happen.
Yes.
And that's why open banking, open finance is going to help with that. Because I need the data of my competition. I need the data of the SME lender here. I need the data on the bank here. I need transactional data. I need to make a decision, a well-informed decision.
Gentlemen, on that note, we have to wrap up this podcast because the big duck's going to come and eat us up very shortly. This has been a fantastic discussion. I'm sure we could keep talking forever about it. So thank you all so much for joining me.
Thank you.
Thank you.
Tell me, where can people find out more about you all? Salman.
So I'm on LinkedIn, Salman Akhtar, Salman, last name Akhtar.
Nice. Walid?
I'm on LinkedIn, Walid Hassouna.
And Abdullah?
Abdullah Al-Moyed, LinkedIn as well, Tarabut, Tarabut.
Awesome. And you can also surprisingly find me on LinkedIn at David BG. Thanks for listening, everyone. If you like what you've heard, follow our podcast and don't forget to leave us a review. It helps us to make it better and helps others find the show. As always, if you want to join the conversation, find us on social media. Just search for 11FS or Fintech Insider or email podcasts@11fs.com. Thanks very much and goodbye.
Thank you. Bye-bye.
Cheers. In today's fast-changing digital world, proving your company is trustworthy isn't just important for growth, it's essential. And that's why Vanta is here. Vanta helps companies of all sizes get compliant fast and stay that way with industry-leading AI, automation, and continuous monitoring. So whether you're a startup tackling your first SOC 2 or ISO 27001 or an enterprise manager vendor risk, Vanta's trust management platform makes it quicker, easier, and more scalable. Vanta also helps you complete security questionnaires up to 5 times faster so you can win bigger deals sooner. The results? According to a recent IDC study, Vanta customers slash over $500,000 a year in costs and are 3 times more productive. Establishing trust isn't optional. Vanta makes it automatic. Visit vanta.com/insider to sign up for a free demo today. That's VANTA.com/insider.